Here with this week's hottest stories in the investment world, this is Zach's Friday Finish Line.
Hello and welcome to the Zach's Friday Finish Line. I am Ryan McQueeney, a content writer here at Zach's, along with one of our editors, Maddy Johnson.
Hello, today is Friday, December 8th, and we're here to recap this week's biggest stories from the investment and financial world. In kind of pretty much many ways, it feels like some of the year's most compelling business stories, and a lot of stories have kind of trailed into these or packed into the last few weeks here.
Yes. Business, finance, politics. It's been crazy the past few weeks.
Yeah, and we're going to do, our best to cover the most important market-moving headlines from the past few days.
Yeah, and real quick, I just want to continue a couple stories we've touched on over the past few weeks, some of the bigger ones that have been in these crazy jam-packed past few episodes. So this week, Bitcoin continued its historic run, knocking down new $1,000 increments like it was its day job, and touching as high as $19,000 US on some trading platforms Thursday morning.
Oh, I didn't realize it went that high.
Yeah, remember what?
Well, this
weren't
earlier,
we just talking about 11,000 last week?
Yeah, just 11. All right. Yeah, Bitcoin crazy. Actually, you know that Bitcoin is making an impact because I've seen a lot of Bitcoin memes on my Instagram feed.
Oh, once it gets memed, it's out there.
It's out there. It's in the public sphere. And also, it actually looks like we're going to see the entire Marvel universe join forces eventually. So new reports suggested that Disney and Fox are once again talking. They're having some meetings, and this time getting quite close to an asset sale that would see Fox's movie studio and television production divisions, which that includes cable networks FX and National Geographic. FX is probably one of my favorite cable networks.
They have good TV
all
shows.
Of my favorite television shows.
Good TV shows.
Well, not all of them. 2 of them. American Horror Story and then American Crime Story. 1, The People versus O.J. Simpson.
Yeah, this
and
new
then
season looks good.
The new one, The Assassination of Gianni Versace. OMG, the trailer looks amazing.
Maybe for the third season, they could explore whether Walt Disney's
The third season
body
is the Hurricane Katrina.
It's
already confirmed.
Well,
and I actually think the 4th season is about the Bill Clinton Monica Lewinsky scandal.
Ooh, okay.
Oh, I know.
Fun.
It's going to be so good.
I like the first season, so I'm in on that.
Right?
And we can get some Mickey Mouse appearances at some point.
Fantastic. Yeah, so that looks like it's going to happen. But I do want to say that at some point in like the last few weeks or so, Comcast was like a rumored buyer of Fox's assets, and so was Verizon.
Mm-hmm.
But it'll also be interesting to see if this major media deal would even go through, since the DOJ is currently suing AT&T to try and block their merger with Time Warner. So who knows at this point? But it's always interesting when these types of talks emerge.
Definitely could be a story that has a huge impact on the media and entertainment landscape. Moving on to this week's stories, I want to start off on Wednesday afternoon. Discount retailer Dollar General posted its Q3 earnings results. The company reported revenues of $5.9 billion, which marked an 11% jump from the year-ago period. Dollar General also reported adjusted earnings of 98 cents, beating the Zacks consensus estimate of 94% and also increasing 10% year-over-year. The company's comparable store sales increased 4.3% year-over-year, primarily due to a rise in both average transaction amount and overall traffic. So that 4.3% is pretty solid for retail comps these days. Consumables, seasonal, and apparel categories provided a boost to comps, while home products had a negative impact. So interesting to look at what the shopping trends have been there. Dollar General also confirmed plans to open 900 new stores next year and execute 1,000 store remodels and 100 store relocations in 2018. Quote from CEO Todd Vassos, quote, "We continue to believe that investing in the business through our high-return new store growth is the best use of our capital to help drive long-term shareholder value." So that's the end of that quote. That I wanted to highlight just for a couple reasons, most notably because we brought up comps, and it's always nice to see what comparable store sales are. It seems like most retail earnings reports are reacting to that figure these days. However, it's also interesting to note that Dollar General has identified new store growth as an efficient way to deliver what it's calling long-term shareholder value. And that kind of is in contrast to a major store closing trend that is happening elsewhere in the retail industry. According to Credit Suisse analysts, about 8,600 retail locations will have closed their doors by the time 2017 is up. And that's a figure that tops the number of brick and mortar locations that shuttered during the 2008 recession. So it has been a year of store closings left and right throughout the country. And Dollar General not joining in on that trend whatsoever. They're opening hundreds and hundreds of stores. So I just wanted to point out that was an interesting trend. And another thing that emerged from Dollar General's report was its impact on other discount retailers. So companies like Dollar Tree and Big Lots, where the in-store experience is very similar as far as types of products you'd be shopping for and price points that you're shopping at, their shares were lifted on Thursday. And then other discount retailers that are kind of sale-first people, Burlington stores, Ross stores, also saw their shares move higher on Thursday. And on that note, we should say shares of Dollar General touched a new 52-week high on Thursday.
People love the treasure hunt.
So the demise of retail has been greatly exaggerated. And we're seeing life in discount retail for one, and we're seeing life in other areas of retail, kind of these niche specialty areas. And Matt, you have some earnings results for us in that segment.
Yeah, so Lululemon posted its own third quarter results on Wednesday afternoon. Ryan, are you a Lululemon shopper or customer?
I do not currently have any Lululemon clothes, although somehow we have like a dozen of the bags at our house.
Oh, yes. I have about 1 million in my own closet.
I like the branding. I like the logo. It's a little bit more expensive than stuff that I would shop for typically. And I'm without revealing too much about my own personal figure because I'm a podcaster, so I'm behind the mic. I don't know if I'm necessarily the target audience for athleisure wear.
Athleisure. Anyways, I personally have been shopping at Lululemon more and more, I guess like this past, I guess you could say their third quarter. Interesting.
Spoiler alert.
Coincidence. But earlier in this year, and even last year, they were going through some sales hurdles. You know, collections were off, colors randomly just like weren't hitting the mark with customers.
Sure.
Like if you have like black colors and it's like all like grays and taupes and blacks and nothing, like no like pops of color, like, you know, customers, it's not appealing.
Sure.
So this past quarter, the company saw revenue figures of $619 million, which surpassed our consensus estimate of $611.47 million and actually grew 14% year over year. So Lululemon reported earnings of 43 cents per share, and this missed our Zach's estimate of 52 cents per share. But if you exclude the impact of the Aviva restructuring, earnings were actually 56 cents per share.
What is Aviva for those who don't know? One of their brands?
Yes, it was one of their older brands that they ended up selling off, I believe.
Okay.
And total comparable sales surged 8%, while direct-to-consumer net revenues increased 26%, while you have a gross margin coming in at 52%, which reflected an increase of 90 basis points from last year. So for Q4, Lulu expects revenues in the range of $870 million to $885 million, and this is up from the $790 million posted in the fourth quarter a year ago. So here's a quote from CEO Laurent Potdevin. Oh God, I totally butchered his last name. I apologize. So quote, "As we start the holiday season, I'm energized by our momentum and we are increasing guidance to reflect this performance. I'm grateful for the enthusiasm I see every day across our collective as we remain on our path to delivering $4 billion in revenue in 2020. End quote. Lofty goal, but
advantageous, yes.
I do think they could probably do it. So as a result of this report, shares of Lulu surged more than 7% to touch a new 52-week high on Thursday. Yeah, they're doing great. And I do want to say, like, this report is proof that Lululemon, it's still a force to be reckoned with in the broader athletic apparel space, even though athleisure has become somewhat normalized. Where, like,
saturated.
It's
too.
definitely
Everybody
saturated in the
has-
market. That's a really good way to put it. But people are still wanting to go out to a Lululemon store or go to lululemon.com and spend $100 on a pair of leggings.
Yeah, that's a good point with Lululemon.com because that direct-to-consumer revenue up 26%. I'm assuming that's mostly online sales. And taking a step back now because we talked about discount retail. We talked about Lululemon, which is kind of a specialty retailer with that athleisure, very strong hold on that athleisure market. It's interesting to note the companies that we have seen have positive reports this season. It seems like we're still seeing some struggles. Some of the big department store chains are having issues still. Some of the more big box retailers are finally starting to put it together. But we spent a lot of time talking about Dick's Sporting Goods, and that's a company that has a strong hold in a niche market in that it's a sporting goods retailer, right? But that's a big, gigantic store that is almost like a department store and is easy to get lost in. But these companies like Lululemon that have smaller stores, it's a quicker kind of in-store experience. You get less options would be one way to phrase it.
Yeah, that's a good way to put it.
You're going there and you kind of already know what you're going to see because you're familiar with the brand and you're a fan of it. If people are fans of brands.
Well, also and then you have higher priced product, right? I
Sure.
mean, you're not going to go out, like, usually you go in there and you spend at least $100.
Right.
And if you want more than one thing, I mean, you're already, what, $250?
And that's a
$300?
really interesting contrast because it must be almost two different groups of people driving these two areas of retail then too. The people who are interested in going to a Lululemon to spend a lot of money on a few things, good quality stuff, but it's expensive, versus people who are willing to go into a store like Dollar General to save money. You would have to imagine that those are two different groups of people.
Oh, 100%.
But they're two different groups of people who have money to spend and are spending it in certain areas, and we're seeing the companies, reap the benefits of that.
Right.
So it's interesting to notice the trends that are now happening in retail.
Well, the thing is, with a pair of Lululemon leggings, it's not like they're not a throwaway pair of leggings.
Sure.
One would hope, fingers crossed. When you're shelling out $100, you're going to hope that that's going to last you at least a year after, rigorous exercising in them. And whether you do yoga or you're on a spin bike or you're in like an intense interval class, like, you're going to hope that when you sell out that kind of money, they're going to last you for more than 2 wears.
So it's a high quality product as well.
So my theory when I spend that much money on a pair of leggings is I'm investing, right? If I'm paying $20, I know that it's probably only going to last me 5 times through the wash, and I might have to throw it away.
So on a really basic, like more simple level of economics, then we are noticing that people are willing to do that right now in the economy. They're willing to go out and invest in good quality products. And there's enough of those people deciding that they are willing to do that to support companies like Lululemon. There's also enough people, whether it be because they're not making a ton of money, wages haven't increased that much, or whatever the case may be, there's probably an entirely different set of people who are driving the growth that we're seeing in these discount retailers at a store like Dollar General, where you're really talking about some of the lowest prices that you're going to get in stores.
What do they sell at a Dollar General these days?
Well, I mean, we know for sure that they noted in the earnings report that consumables, seasonal, and apparel categories helped to drive comps. So those are the 3 areas that they highlighted. Consumables, I would imagine, is mostly food,
right?
And then seasonal and apparel categories. So I guess talking about like decorative things, seasonal would imply to me in Q3 like Halloween stuff.
It reminds me of like the kind of not resurgence, but like growth of Aldi here in America, right? People don't want that whole paycheck anymore. They don't want to go to Whole Foods and literally spend their whole paycheck on groceries. They would rather go to Aldi and spend half as much, or maybe like a third of what they would spend at Whole Foods at Aldi, and get like 2 weeks worth of groceries.
Yeah.
So it's like, I think there's like certain things that people will spend money on and not, but that's also, again, subjective based on income levels, based on the economy.
Well, that's actually a really good
factors.
point, because now you have me thinking that maybe it isn't two different groups of people that are driving the growth at these companies, because if you're saving money on groceries because you want to spend it on something else, maybe it's because you want to go spend it on higher quality clothes at a Lululemon, or, you know, somewhere else in the economy. You know, I feel like we imply that people, I don't want to imply too heavily that everyone that's going to the discount retailers is doing it because they can't afford to do anything else. They could very well be saving the money, or priorities on a consumer level have changed, and we'd rather save money and go to Dollar General so that we can go to Lululemon for our clothing instead of going to Target for all of those things. I don't know. Maybe that's what's happening.
Yeah.
So
it's
I guess
always interesting to think about, especially now that retail is just in general doing so much better
a strong
than it
bounce
has
back
been
in the second half of 2017 for sure. But yeah, all right. So we're going to move into a completely different industry now, with an equal amount of activity going on. This is healthcare. We're going to start off with the CVS Aetna deal. CVS Health officially announced its purchase of healthcare benefits giant Aetna on Monday. CVS acquired the health insurer in a cash in stock deal worth roughly $69 billion, including debt. The deal is valued at $77 billion. After the close of the transaction, Aetna shareholders will own nearly 22% of the combined entity, while CVS Health shareholders will acquire the rest. So it's kind of a weird merger acquisition stock cash deal where they got to figure out the numbers there. But at $69 billion, that is a large deal nonetheless. CVS CEO Larry J. Merlo said, quote, "This combination brings together the expertise of two great companies to remake the consumer healthcare experience." Continuing on, the merger will allow the companies to offer more healthcare services at CVS stores, making the infamous pharmacies more of a one-stop shop for health-related products and treatment. And on the deal's successful completion, CVS Health expects to earn $750 million from near-term synergies, with low to mid-single-digit accretion in the second year after the transaction's closure. However big this deal was, and one that will certainly shake up the healthcare industry, one that we'll be talking about for quite some time, and as we've talked about with other deals, going to be one that's going to have to go through a really stringent regulatory process.
Oh, yeah.
I can't even imagine.
I would not want to be part of that.
Yeah.
But you know how they say that a pharmacy is like a poor man's doctor?
Sure. Now it like literally is
it's an every man's doctor. So
trademark Zach's Friday.
So I do think this deal has the potential to be absolutely groundbreaking for the healthcare industry and the pharma industry, in the insurance industry.
Yes,
so many industries.
Definitely. And
but yeah, the regulatory concerns, oh my God, it like makes me anxious.
I would
just,
imagine
like,
it's going to be teams of people's jobs for the next couple of months is to figure that whole thing out.
Yeah.
But yeah, this big shakeup and kind of a redefinition of how we look at pharmacies and health insurance providers, healthcare providers, health services providers. It's kind of a growing trend now, consolidation in all of those industries. We actually saw another move in a similar vein later this week.
Yeah, so UnitedHealth's Optum division announced on Wednesday that it was acquiring DaVita Medical Group, which is a unit of DaVita Inc. for nearly $5 billion. And so DaVita is known for kidney care and especially their dialysis treatment centers. I see them randomly like all over my parents' hometown, which is Rockford, Illinois. There's one like built next to like a tire shop and a grocery store. I'm like, oh, there's a DaVita clinic. Great. But also not so great because a lot of people clearly need dialysis. That one had to pop up there next to a tire center.
Good point.
Anyways, UnitedHealth, which is the country's biggest health insurer, will pair DaVita Medical Group's 300 medical clinics, 35 urgent care centers, and 6 outpatient surgery centers, which actually reach around 1.7 million patients a year, with Optum's massive insurance segment. And Optum also runs its own primary and urgent care centers, surgery centers, and senior and advanced care centers. So this whole combination is going to grow into an even larger patient care network. UnitedHealth's latest deal is its second acquisition in 2017, which is aimed at bolstering its offerings beyond insurance. Back in March, UnitedHealth purchased surgical care affiliates for $2.3 billion. So shelling out the cash this year.
So whether it be CVS, Aetna, United, DaVita Medical Group, UnitedHealth, and surgical care affiliates, we're seeing this a trend around the healthcare industry of consolidation, but more specifically benefits providers getting more acquainted with services providers and seeing that synergy there, which they will tell us is something that will help patients and lower prices and help accessibility. We'll see if those benefits actually come to fruition.
I guess we have to find out and get hurt and go to an urgent care.
Go to that dialysis center next to that tire shop in Rockford, which I'm assuming is probably part of this deal. So let me know if the next time that you're there, if the logo changes or anything like that.
I will.
So another interesting trend in an industry that is in flux, whether it be healthcare, retail. We're seeing a lot of these traditional businesses really change the way that they go about things, and something that we're going to keep our eye on going forward and into 2018. But that just about does it for us this week. As a reminder, feel free to shoot us an email at podcast@zax.com. If you have any questions, if you feel we missed anything, or if you'd like us to cover a different story, you can also check out all of our other exclusive audio content at zax.com/podcasts. Remember to subscribe and leave us a rating on Apple Podcasts. Thanks again for joining us. We will see you next time on the Zax Friday Finish Line.